Hey guys, I created a little visual representation behind me. In under 5 minutes, I'm going to try my best to explain what it is that our investment firm does, how profits are realized and shared amongst our partners, and then also the flow of capital and what that looks like from the time a tenant pays rent to the time our passive investor receives a check via cash flow. And so here I have behind me Legacy Park Apartments. Everything is projected and calculated on an annual basis. Okay, you can look at this and we call this a little mini pro forma of our projected revenue and expenses for the future. So the tenant pays rent, you have all the tenants, and you add all that up, multiply it by 12 to get an annual amount of income, and that equates to the gross scheduled income. Now the difference between the gross scheduled income and the gross potential rent is something called loss to lease. If the owner of the building isn't capitalizing on the max rent that they could charge for that given market, then there is something called loss to lease. So there's an opportunity to increase rents up to what the market allows, right? And so that's what that term means. And it's typically an opportunity for us to go in and realize some appreciation that we'll realize upon sale. So once you have gross scheduled income, you subtract out your physical vacancy, the units that aren't rented, and you subtract out bad debt, which is congruent to collections loss, or the amount of money that we basically don't collect for whatever reason. And then you subtract out concessions. Think of concessions as free rent or incentives to sign a lease. So it might be a couple months free rent. It might be a different type of incentive of some nature. But then you add in other income. Think of things like application administration fees. Maybe you have storage units that you charge per month. Maybe you have coin laundry that you charge. It's money coming in that's in addition to your rental payments. And then from there you arrive at effective gross income. Effective gross income, typically operating expenses are 50% of that. So you subtract out your operating expenses and you arrive at this thing called net operating income. And NOI is an extremely important term in this industry because you take the NOI and you divide it by something called a capitalization rate to arrive at the purchase price of the asset and the value. So the capitalization rate, think of that as a rate of return that investors are willing to accept for an income stream in any given market for a specific asset class. So that is how you arrive at your purchase price. Now, in order to fund these acquisitions, we typically get a loan for 70 to 75% of the value, and then we fund the rest, 25 to 30%, with equity. Of the 25 to 30% equity, the operators or general partners, the people running the deal in the operations, usually put in 5 to 10% and co-invest with passive investors who are known as limited partners, who will fund the majority of that 25 to 30% equity. So the return structure looks something like this. Usually we offer a 6 to 10% preferred return pari passu. Pari passu means side by side. Basically, say the preferred return we're offering is 8%. The LPs will receive 8% on their money, and then we will also receive, as operators, 8% on our money. So we side by side receive that annual return based on our invested capital. And then above that pref, there are cash flow split shifts based on exceeding investor returns. So there are multiple different ways to structure it, but a typical syndication, a lot of the times you'll see a 7 to 8 to 9% preferred return, and then over and above that preferred return, the general partners capture a disproportionate amount of cash flow relative to their initial invested capital, which is very little. But it's basically like their incentive for outperforming in the deal, for increasing returns up and above a level that were promised to investors, and they get a little bit of compensation for that. And so typically it might look like an 8% pref, a 20% promote up and above the 8% pref, and then there could be additional waterfall hurdles. We call this a waterfall method because you have buckets of return hurdles, and once that bucket is filled up with cash flow, it trickles over to the next bucket, in which a cash flow split is generally shifted a little bit in favor of the GPs to, again, compensate them for producing outsized returns. So this is our business in a nutshell. If you have any questions or want some more clarity on anything that I discussed, please feel free to message me, and thank you for watching.